Hello, welcome to my channel, The Entrepreneurial Mindset. My name is Jay Berman, and today's presentation is called Essential Accounting Concepts, Episode 6. The concepts in this video come from my book, Is Your Business Idea a Good Investment? Available on Amazon.com, Kindle version only. Go to the Amazon search bar, select books, type in my name, Jay Berman, scroll quickly to my book to purchase, and by doing so, you support my channel and my work in entrepreneurship and business education. Thank you. So today I'm going to cover the third and final spreadsheet, financial accounting. The first one was income statement. The second was the balance sheet. So today I'm going to cover the statement of cash flows. And the statement of cash flows consists of operating activities, investment activities, and financing activities. Again, I recommend the skill Microsoft Excel or Google so you can create your own statement of cash flows. So why is a statement of cash flows important? Well, number one, all companies need cash to ensure liquidity. Liquidity from French word liquide, meaning cash. So in other words, companies need cash to pay their operating expenses, which you would have calculated on your income statement. The statement of cash flow also tracks cash entering, which means positive cash flow, and leaving, meaning negative cash flow, a business's checking account. Again, I highly recommend separating your business finances from your personal finances by having a separate business checking account for your business. So let's first talk about operating activities. Cash flow from operating activities is calculated by taking the net income or net loss calculated from the income statement and adding depreciation, which again is also listed on the income statement under operating expenses. But just take a special note that the reason you have to add depreciation to net income or net loss is because depreciation is not a cash expense. A depreciation allows a company to expense a long-term asset from your balance sheet over a specific number of years. So when you have a positive cash flow, it's net income plus depreciation. Cash is flowing into a company's checking account, thereby increasing the cash on hand, as noted under cash, which is listed under current assets on your balance sheet. You can also have a negative cash flow, which means net loss plus depreciation. Cash is flowing out of a company's checking account, thereby decreasing the cash on hand as noted under cash, which again is listed under current assets on the balance sheet. You have a positive cash flow when you have revenues coming into your business, into your checking account, and you have a negative cash flow when you are paying your operating expenses. Next is investment activities. Company records the cash used to buy or sell assets. Assets are items owned by a company that generate revenue from the sale of goods or services. But please take note that negative cash flow is, in terms of investment activities, is not necessarily bad. Companies buy assets all the time in order to increase future revenue. Companies use the net present value before purchasing assets to ensure that asset offers a good rate of return considering the investment or the upfront cost of that particular asset. So in terms of investment activities, you can generate a positive cash flow, which means when a company sells an asset, companies do it all the time, they sell assets, the positive cash flow becomes cash is flowing into a company's checking account and increases cash, which again is a current asset on your balance sheet. Negative cash flow: when a company buys an asset, the cash flow is negative because cash is flowing out of a company's checking account. Negative cash flow decreases cash, again, on your current asset on your balance sheet. But again, in this case, a negative cash flow, again, is not necessarily bad because you're buying assets that you hope will generate future revenue. And then the third part of this statement of cash flows is called financing activities. So that's debt, cash from debt and equity to finance investments. So there are two ways you can finance investments, and in other words, purchasing of assets. You can either take out a loan, which is a debt, or you can raise money from investors. So you would have a positive cash flow because the money is coming from banks, in other words, proceeds from a loan, or investors, their cash increases cash, which again is a current asset on your balance sheet. You would have a negative cash flow because this is where you make your principal payments. You record your principal payments on financing activities or in your statement of cash flows, because principal payments decrease cash. Investors are normally not paid back. Investors may receive dividends, cash from retained earnings, which is listed under owner's equity on the balance sheet. And this is a sample of a statement of cash flows. So you have your operating activities, investment activities, financing activities, total cash, and you have year 1, 2, or 3. And that should be more than sufficient to help you create a statement of cash flows. You only need 3 years in advance when you calculate your statement of cash flows. Again, recommending that you use Microsoft Excel or Google Sheets. And that's the end of this presentation. Any questions or comments, use the comments section below. Subscribe to my channel for more educational content about entrepreneurship. And I thank you for watching.